is this repricing that we've seen, the market saying to the Fed, okay, you did get a passing grade, you haven't quite made a mistake just yet?
Yeah, I mean, I think the Fed has done a really good job. Chairman Powell's on his way to achieving a second soft landing. That's been the a priori, is that as soon as they had the latitude to cut, they would move towards doing so. They're moving towards doing so. And the payroll growth is strong. The thing that's pushing up the unemployment rate is the growth in the labor force. So this economy has the potential to grow faster. They want to tap into that, extend the expansion, cut rates. The pace of cuts priced into the market is aggressive, though. And at every soft data print, every low inflation print, the market has moved towards a kind of the better part of 2% of rate cuts in the next year. And I think the reason for that is really investor positioning. Investors have had a big increase in their wealth through home prices, through equity values. Money market balances are incredibly high. The only thing investors have not really locked in is the stream of income. And that's why we're seeing this asset allocation trade, and it's keeping the Fed pricing on the aggressive side.
Well, George, you guys at Allspring have been on this for a while. You have been diversifying duration and where you actually invest. And I'm curious as to where you stand now that we've had so much repricing and repricing and repricing. Earlier today, for example, Noel Dixon from State Street said he wouldn't be comfortable recommending the 10-year duration until the 10-year yield is back above 5%. Where do you stand on what's the best duration for somebody to go into right now?
Yeah, a central message from us has been diversify duration. That can be viewed as simply as just extend, adding duration, as Robert mentioned. Sort of those coupons, those income streams had been fairly attractive earlier this year. Yields have come down quite a bit, but are still fairly attractive. In real terms, we still have fairly strong positive real yields. And so we still would be willing to extend a little bit of incremental duration. Our view is that the 10-year yield between, say, 3.5 and 4 is going to be closer to fair value. So, I mean, hoping that yields get up to 5 might be a bit of a stretch. But we think if with 10-year yields in and around 4%, we still think that's a pretty good value area, especially for an economy that is decelerating. And as Robert mentioned, with rate cuts likely to come, the sort of the overbought part of the market, I think you had a chart of it earlier, was the 2-year part of the curve, which rallied very aggressively, and we were willing to pare back some exposure around the 2-year as it rallied to its lows. But now it's coming back up and more in line with a more measured pace at the front end.